Hi everyone. Today we're taking a look at exercise 4-4. Let's read the problem. Allied Merchandisers was organized on May the 1st. Macy Company is a major customer, aka buyer of Allied, who is the seller of products. Prepare journal entries to record the following transactions for Allied, assuming it uses the perpetual inventory system and the gross method. Allied estimates returns using an adjusting entry at the end of each period. So let's take a look at the first transaction. It says Allied made its first and only purchase of inventory for the period on May the 3rd for 3,000 units at a price of $12 cash per unit for a total cost. The total purchase price was $36,000. So what two accounts would be involved in this transaction? Well, we know that merchandise inventory grows. It grows by 3,000 units at a cost of $12 each, or altogether, we're going to debit inventory, increase inventory with that debit of $36,000. What did we give up to get that inventory? We gave up cash, and so cash goes down with a credit for $36,000. Okay, let's take a look at the next one. It says Allied sold 1,400 units of the inventory for $20 per unit. They invoiced $28,000 to Macy Company under the terms of 210 net 60. So they pay within 10 days, they give a 2% discount. Otherwise, the net balance is due in 60 days. That says the cost of the goods was $16,000 to Allied. So we've got a couple of transactions here. Let's just take it one step at a time. First off, we know that they sold some merchandise, and the amount of the merchandise, the invoice, as it says, was for $28,000. Now, they sold it on credit, so the account receivable balance is what increases 14,000 units at $20 each. The sale was for $28,000, and receivables increased by $28,000. That's how we handle the sales portion of transaction from May the 5th. Now let's handle the expense portion. We've used up some inventory, so the portion of the inventory that got used up at the period will become an expense for the period. The company sold 1,400 units. What did that cost them? Altogether, that cost them $16,800. So we want to reduce inventory by $16,800. We reduce inventory with a credit, and that portion that we reduced is going to get expensed out as cost of goods sold expense, or simply called cost of goods sold, also for $16,800. Okay, not so bad yet. Let's take a look at the May 7th transaction. Let me get to a new screen here. For May the 7th, it says Macy returns 200 units because they did not fit the customer's needs. Customer doesn't want this. They were invoiced $4,000. Allied restores the units, which cost $2,400 to its inventory. So two things here are happening as well. First, the sale is getting reduced, and also inventory is getting put back. So as the sale gets reduced, account receivables also get reduced. As inventory gets put back, inventory grows, and cost of goods sold gets reversed out. That expense gets reversed out or reduced. So one step at a time again. The sale, we're going to track that sale in the account called Sales, Returns, and Allowances. That way we can keep good track on not just sales, but what portion of the sales customers return. So that's why we have that separate T account. Remember, it's a contra sales account, and so it's going to grow with a debit balance. Sales typically grow with credit balances. The contra grows with the opposite, and so in this case, a debit balance. So we're going to debit sales, returns, and allowance for $4,000. That was the 200 units, total invoice price $4,000. And account receivables are going to go down by $4,000 as well. They go down with a credit balance. So that handles the sales portion. Now we need to handle the inventory portion and the cost of goods sold portion. So the materials cost $2,400, so we're returning $2,400 worth of inventory back to our inventory, so we debit inventory for $2,400. Our cost of goods sold expenses, remember expenses grow with debits, but we're reversing that expense out because we don't have the expense any longer. The customers return some of the merchandise. So we're going to credit cost of goods sold expense for $2,400 as well. Okay, so that takes a look at the 7th transaction. Let's take a look at the May the 8th transaction. It says Macy discovers that 200 units are scuffed, but are still of use, and therefore keeps the units. Allied sends Macy a credit for $800 towards the original invoice amount to compensate for the damaged goods. So what we look at here, well, this is an allowance. This is the perfect example of an allowance. and the price has been reduced, and so we're lowering our sales price again by $800. So remember, sales were credited initially. Now we're reducing that overall sales with the $800 allowance. And a lot of companies keep sales returns in one T account and allowances in a separate account as well. Once again, our account receivables are also going down because we're saying the customer doesn't owe us as much as they did before. We've knocked off $800 from the sales price. Notice there's no transactions to do to cost of goods sold or expenses because we still have the same level of expenses. We still have the same level of inventory. The company is just giving a lower price to the customer, passing on a lower price. Finally, the May 15th transaction, Allied receives payment from Macy for the amount owed on May the 5th purchase. Payment is net of returns, allowance, and any cash discount. So we take the $28,000 minus the $4,000 that was returned, minus the $800 returned, and that means the account receivable balance then is $23,200. Now they're paying that $23,200 before the discount expires, so they're going to receive a 2% discount. So $23,200 times 2% means they have a savings or a sales discount of $464. So we're lowering again our total sales by the amount of the sales discounts. We have those credits for the sales. We're lowering sales by sales returns, we're lowering sales by sales allowances, and now we're further lowering sales by sales discounts, and that's in the amount of $464. Last, we receive cash for the balance, which is the difference between how much they owe and the discount, or $22,736. And that's a look at this example.